Hey there, everybody. Happy Monday. Hope you had a great, restful weekend, and welcome to Monday, March 24th edition of Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully overcast and cool Redmond, Washington. Hope you are doing well and enjoying life wherever you are at. Speaking of raging bull markets, we appear to be back in one, and I say that with a great dose of skepticism. I think still TBD in terms of a return to any sort of bull market declaration, but we are very much getting a counter trend bounce, and I think that is 100% happening here. We talked about the signs of a nice bounce off of 5,500. We're getting it. The S&P now over 200 points above that support level here from just a week and a half ago. So it's certainly been a nice upside bounce. I did a video earlier today for Stock Charts TV, digging into the Magnificent Seven names one by one, really focusing on some key levels to focus on. So if you follow my work over there, you should check it out. The channel is called Stock Charts TV. I do a show once a week, usually on Monday afternoons. I believe it's posted now, and if not, it should be posted here very, very soon. So I hope you can check it out. A little more detail into something we don't have time probably to dig into as much on today's session. But the reason why I did that particular topic today was because that's where I think we need to focus, right? As much as we can talk about a heat map with a lot of green, which is true, a lot about how we can talk about a lot of different names and where we're seeing potential strength. If your goal is to assess the potential for the S&P and the NASDAQ pushing in a significant way further than we've seen so far, it has to be driven by mega cap growth stocks. They're just too big of a weight that if they're struggling, the major benchmarks just have limited upside. But just the math is how that works out. So the question is, how much of a sustainable rally do you have in some of those names? I have a couple of those that I grabbed along with some other names in other sectors to review today. But with that in mind, let's get to the market recap and focus on what actually played out. If you enjoy the color green, you're going to very much appreciate what I'm about to show you, because there's a lot of upside moves today. The S&P up 1.8%. That's a full 100 points on the S&P to close just above 57.67. And again, not too long ago, we're talking about 5,500 as potential support. That support now very much confirmed with a nice rally off of those lows, 100% true. The NASDAQ composite even better, up 2.3% to 18,188. Mid caps, small caps, all in the green. And the S&P 600 small cap index, the biggest gainer, up 2.6%. I did not grab a chart of the IWM, I don't believe, but the Russell 2000 ETF is doing a very similar thing to NVIDIA, which is a chart we are going to look at a little bit later, with the dreaded death cross. I will show you what that means, why people may be asking about it, how I would suggest you think about signals like that. So both the small cap ETF and NVIDIA, and certainly probably some other names that I've have not noticed yet, giving a death cross. We'll get to that a little later. When we get to the charts, the VIX continuing to move lower, almost 2 VIX points down. So we're down around 1750. So well below that 20 threshold. As a reminder, I mentioned my recent interview with Jay Soloff, who's a lead options analyst at Investors Alley, former market maker at the CBOE in Chicago. We talked all about the VIX, and I can't stress enough. It was a really cool conversation. Being able to ask someone like that who spent their career looking at volatility, hey, how do you think of the VIX? How has it changed? What levels are important? What does it mean right now? What are VIX futures? How do you think of those? What about the term structure and how that's changed? He had great answers to every one of those questions I just kind of threw out there. So please make sure you listen to that interview on the Market Misbehavior podcast. That's on my YouTube channel. It was a lot of fun. Really a smart guy in the option space, which was a pleasure to discuss for sure. All right, so equities all in the green today. What happened with the other asset classes? Bonds actually moved lower today, so stocks and bonds continue to have a bit of an inverse relationship. The TLT was down about 1%. Interest rates generally drifted higher today. You can see the 10-year yield around 4.33, the 5-year point around 4.1%, 30-year point right around 4.65. The dollar really not much of a change. Really haven't seen a big spike in the dollar in quite some time. We're seeing sort of a no more downtrend in the dollar, arguably, but not a big strengthening in the dollar, and that's been a key trend so far in 2025 has been the weakening dollar versus other currencies. So for now, I would say that weakening trend is still very much in play here. Looking at the commodity space, the DBC up about 1/3%. That's a broad commodity ETF. That's not a big move in that ETF. Gold and silver down slightly, copper down slightly. Energy prices generally higher. The crude oil ETF that we track, the USO, up about 1.5%. Gold and precious metals, I think the charts are still very, very good. We're pulling back while equities are kind of rallying off of the lows. You're seeing gold and silver kind of rotate down after making new all-time highs, with gold pushing above $3,000 an ounce earlier this month for the first time in history. So still a good trend, I would say, but certainly seeing a bit of a pullback as risk assets are rallying off of their recent lows. A lot of upside follow through in the cryptocurrency space. Bitcoin's still below 90,000. We're right around 88,000 as we go live today after the equity trading session. I did grab the chart of the GBTC just to show how a Bitcoin ETF has been trending relative to the levels in Bitcoin that we've tracked about. Over the weekend, Bitcoin was actually down in the low mid 80,000 range. And then today, going into the equity session, saw a nice rally here. We'll talk a little bit about the sources of the equity rally today. Someone already in the chat has mentioned it was a BS move. Don't quote me on that, but it certainly was a head scratcher of sorts. I mean, there's a big headline risk right now. Hopefully you can feel that, right? When Trump and with other news out of Washington, when it implies anything about tariffs being lighter or less painful, the market has taken that as a huge blank check to just rip to the upside. But then even through the course of the day, we got additional comments about more tariffs are coming and still this kind of open-ended thing. So it makes me feel like these rallies are not long-term, everything's great kind of rallies. They're kind of short-term rallies, but within a general environment that has not gotten much better. There's still a lot of uncertainty, even in the next couple of weeks going into the April 2nd deadline. But I digress. All right, let's look at the 11 S&P sectors. We can see consumer discretionary at the top of the leaderboard. Now you have Amazon sort of pushing above its 200-day moving average, or attempting to do so and attempting to hold that. You have Tesla with one of its biggest up days in a long time, up over 10% today. I did not grab the chart of Tesla just because I had enough of the FANG stocks to kind of go through, but the chart of Tesla, again, I would say still in a downtrend. This is a nice rally, but still the general trend, lower lows and lower highs, still very much intact there. And this is after, could be a number of things. I saw a headline, the FBI is opening investigation into the Tesla vandalism that has been pretty widespread here over the last couple weeks. So the XLY up almost 4%. That is by far your best performer. Technology number 2 up almost 2%. Industrials number 3 up 1.9%. Financials number 4. I did grab the chart of Morgan Stanley just to show that it's not just growth stocks that are having a bit of a rebound here. It's some of the other things too. Some of the value sectors like industrials, financials having pretty decent updates today. On the downside, utilities ended up being the only one finishing slightly in the red, and it was basically flat from Friday's close. Consumer staples and healthcare were second and third from the bottom, both up just below 1%, but moving up as well. Let's see. What else can I tell you here on the old front page of Stock Charts' market dashboard? Breadth overwhelmingly positive today. And if you'll note at the bottom there, mid caps and small caps, 90% up days when you look at the number of advancers versus decliners. That's something I was taught. Trying to think of where I first heard that, but I remember Walter Deemer, often making noise about that. He had a bit of a different way of calculating 90% up days. He would actually use volume as part of the calculation. This is just looking at whether stocks closed above or below Friday's close as the determination of what bucket they're in. But 90% up days is a pretty widely documented phenomenon where you have just almost everything moving up, and the short version is it usually doesn't happen in bearish phases, right? This is something that is usually an impulse move to the upside, something to watch. Now, note that while mid caps and small caps had a 90% up day, large caps did not have a 90% up day. It was about 85% up day. The NASDAQ Composite had a 65% up day. So about a 2-to-1 ratio, still up over down, but not as overwhelmingly positive. This is one of those where the smaller you got in the cap tiers, the better the breadth conditions looked. And the broadest measure, which is the New York Composite Index, about a 3-to-1 ratio of advancers versus decliners. So a decent update. And you'll see in a few moments on the heat map, a lot of green. I mean, it's just that generally this was a nice bounce. It's certainly a strong way to start the week. My question with all these things is, should you be buying into this sort of rally, or just coming up with a really good place to, take the next short position and ride the move lower? That is the question right now, and I know that's what's on your mind. And I'll do my best to share with you the technical evidence that should help inform that decision. But we'll see what we can see here. You can see Tesla, of course, the top performer in the S&P, up about 12% today. Our market trend model, no change. Now, through Friday. Friday was a decent day, but not enough to make the short-term model bullish. What happens when you have this configuration, having used this methodology for a number of years, short-term, medium-term, long-term, 3 time frames, all defined by the weekly chart of the S&P. And I have that chart to share with you in a few moments. But just to tell you what we would be looking for would be the short-term model turning bullish. That could happen as early as this Friday. If we see more days like this, very easy that would be able to be triggered. And if the short-term model turns bullish, that means at the very worst, counter trend rally within a cyclical downturn, because the medium-term model is still bearish. For me, I need to see the medium-term model turn back bullish to signal an all clear, boy, this is a bullish market, and I can't label it otherwise. I'm still pretty comfortable labeling this a bearish setup, again, until proven otherwise. But for now, that's what the model is telling me to think. All right, looking at the leadership growth names. And again, I went through these charts in detail on my show today on Stock Charts TV. And we actually went through, I had a Broadcom in there, so I think there were 9 stocks altogether that we went through. But out of this list, as I mentioned, Tesla up about 12%. And again, one-day moves can be very misleading. Granted, this is a big move, and that is 100% true. Take a look at the chart, though, and you can see we're still below the 200-day moving average. We're still making lower lows and lower highs. I think there's more that needs to be proved on a chart like Tesla, but a strong up move after a consolidation. Meta was pretty important, up 3.8%, because that is one of the FANG stocks trying to hold its 200-day moving average, and I would argue that is crucial right about now. Amazon up 3.6% as well. Broadcom, the only one of these, and I just added it on today as one of these names, because similar to Meta, very, very similar chart in that it's also testing its 200-day moving average. I think the question is whether these names hold that key sort of metric. For now, they're holding, and that's an encouraging sign. Those start to break, and that's where I would start to get really concerned very quickly. All right. Let us continue on to the market carpet on stock charts. This is a heat map style visualization, allowing us to look at a high level at general market conditions, but also focus in on key themes and moves that we want to pay attention to. So immediately I'm struck by the general green complexion to the market carpet today. The average stock was up. It's not universal, though. So the second takeaway is that there's a lot of amber in random places. Not a lot of stocks that were down much today, right? You see very few red boxes, but you do see some kind of amber neutral names. So those are names that really did not participate in the uptrend today. So where did you see the biggest participation? Certainly with the leading growth names. And again, I would say that's if the most bullish thing I'm seeing is the fact that those mega cap growth stocks are starting to rally. They're starting to either, bounce off of their 200-day or, rotate back above and attempt to get back above the 200-day moving average. Like an Amazon, I think that's pretty encouraging, to be honest with you, because there's no chance, in my opinion, for the major averages to have any significant upside without the Magnificent Seven stocks at least participating. So that sort of move is encouraging. The question is just, do we hold those gains, right? Does this continue to go? Do we start making higher lows at some point? That would be really encouraging. But first things first, let's start to go higher. The other thing to note is, where are you not seeing a lot of green? You're obviously seeing green in consumer discretionary. You're seeing a lot of bullish movements in technology in the upper left, certainly industrials. I mean, look at how most of those stocks are actually positive, except for Lockheed Martin. Pretty much everything else in a pretty strong uptrend. Now, some of these are not, I would argue, like, still not great charts. I mean, Train Technologies, TT, reminds me a lot of Tesla. It's a nice balance, right? Granted, 100% true. So if you're a swing trader, very tradable move off of the lows. But as a medium-term, kind of long-term investor, that chart doesn't say uptrend to me now. It says we're bouncing within a downtrend. We're still in a downtrend channel, very clearly, I would say. So I would say still more to prove. I think there are trend lines that have not been broken that would need to be broken before I get really excited about some of those charts. But certainly in industrials today, a pretty decent update. Also real estate, which is actually a pretty defensive sector. You're seeing a lot of REITs actually move higher. And financials, quite a bit of green there. So sorry, I'm still on the bullish chart list. You're seeing a lot of movements in here. Some of these have been names that have been beaten down, like T Rowe, like SYF. These are stocks that have come down a bit, but charts and Morgan Stanley and JP Morgan kind of bouncing off of the lows, but also like a Visa, which did not come down nearly as much, starting to turn higher. What did not participate in this update? I would say healthcare, not as bullish as some of the others in terms of the general participation in the uptrend. So you have charts like Merck actually rotating lower today. Some of the pharma names, some random biotech names I'm seeing in there. Consumer staples certainly probably the worst. Looking at the complexion here on the heat map, a lot of the names like a Hormel, right, food products kind of rotating lower, just actually have rallied to the upper end of a channel and now starting to rotate lower. Communication services outside of Alphabet and Meta, a much more of a mixed bag, right? If you kind of look outside there, and then utilities, right, which is a fairly defensive sector as well. Energy, what's interesting is Exxon and Chevron, which have been the two stocks making new highs last week. These are the two that actually broke out. The rest of them mostly did not. Those two leading integrated names are actually flat today. It's all the other stuff that actually started to rally. The things that have been a lot more beaten down actually starting to push higher. So granted, I would say today, as you're looking at the landscape, I mean, strong update in a lot of stocks. And if you hold some of these names and you've been digesting some of these losses on the way down, it probably feels pretty good to have a nice update and see some gains in your portfolio, paper gains in your portfolio. I get it. Is there enough on a day like today for me to tell you that whole bear thing is behind us and we're now resurging? Like 100% not. And I would tell you that from a technical perspective, in that a lot of more 200-day moving averages would have to be regained and a lot more follow through would have to be demonstrated. A lot of breadth would have to improve, but also the macros. I mean, what really changed in the macro environment from last Wednesday to today? Not a lot. I mean, I would say a lot of the risks are still very much there. A lot of the instability and uncertainty is still very much a real issue we're going to have. I think it's going to be day to day in terms of news flow. And that is, I think, given the new president and his general approach to policy decisions, I'm bracing for that being more the rule and less the exception here in 2025. So let's buckle up for volatility. And again, when in doubt, zoom out, focus on the larger trends and make sure we're participating in uptrends as much as we can. All right, before we continue on with the chart review portion of the day, I do want to remind you, I have a webcast coming up this Wednesday, March 26th, 1 p.m. Eastern, 10 a.m. Pacific, called Relative Strength. Top performers make top portfolios. In my institutional days, we spent a lot of time looking at relative strength. One reason was because that's how we were paid. We were paid to outperform benchmarks. So we studied benchmarks deeply. We focused on relative performance because that was what we were trying to accomplish with the funds we worked with. But I would also say for individual investors, it's an area that I've not found people tend to focus or understand enough of it. And I think it's something that can really help you navigate markets like this, focusing on what's outperforming during a challenging market environment. You can sign up for that free event coming up this Wednesday at marketmisbehavior.com/relative, or just scan the QR code you see above my head on the slide there. I would love for you to join. If you can't make it live, just sign up and I'll make sure I send the replay out at the end of the webcast. I hope you can join me, though. It should be fun. All right, let's dig into the charts. We'll take some questions. We'll be done for a Monday afternoon as we get toward the almost end of Q1 of 2025, which is crazy and hard to believe, but we're here. So the daily chart of the S&P 500, the S&P did indeed regain its 200-day moving average. That's not nothing. And I've mentioned a number of times, right? Until the S&P gets above its 200-day, don't even worry about any sort of bullish trend. So now we're there. We have to think about it. As I mentioned many times, S&P 5850, that's kind of my upside line in the sand. Getting above the 200-day is encouraging because it also gets us above this Fibonacci resistance level around 5725. If you remember, that was a level we got from the August low and the December high. I kind of treated these January and February peaks as failed breakouts above that December peak around 6100. So we did eventually get all the way up to 6150, but I'm thinking of that as kind of the peak. And then this is some additional tests to get above there. From there, we broke down. Instead of holding the 200-day and holding that 38.2% level, we failed, which unlocked the downside target of 5,500, which I would argue we reached almost perfectly about a week and a half ago. From there, we have had a arguably very predictable, nice bounce off of those lows. The question is, at what point does this become a move that you can't avoid participating in? For me personally, I'm still more on the defensive side because of the larger structures that we observed going into the month of March. I think the S&P gets above 5850. It would be hard for me to remain in a bearish frame of mind because that just means there's enough of a rally, and for the S&P and the Nasdaq to get above that kind of level, that means the Magnificent Seven stocks are really going to have to resurge, which means you probably want to participate because there's the potential to keep going much further. So it looks like maybe this week is where we see how that actually plays out, see how we need to tweak positioning as a result. As we mentioned, our market trend model is still bearish on the short-term and medium-term timeframes. I'll show you in a minute how that might have been changed. So for now, I'm watching 5850 very closely. First things first, though, we did close above the 200-day moving average today. Do we get follow through? That's the question for Tuesday, March 25th. A close above resistance is the first step. Do we follow through? Do we have an additional move in that upside direction, which tells you this wasn't just a fluke? This is the beginning of further appreciation. That's the question I would have for tomorrow. Now, for what would really make this chart look more positive? We think about all the things that changed from the end of last year to the beginning of this year. Things like breadth conditions deteriorating. So we'd have to see an improvement in breadth, much more than just one day 90% update kind of move, but more broader improvements in some of those indicators, like stocks above key moving averages, as an example. You would need to see improvement in momentum. So the RSI is still below 50, even with today's surge. So a bull market has the RSI often going well above 50, well above 60, even up to the overbought range. So we need to see a move, an impulse move that actually suggests that investors buyers are taking control and pushing this price higher. So again, still more on the technical side, I would argue, to validate more of a sustained uptrend. Here's where our market trend model stands. As a reminder, I update this every Friday after the close. So last Friday, we updated it with no change. Bearish on short-term and medium-term timeframes, still bullish on the long-term timeframe. For now, we have a placeholder for the current week. We would not change the model until Friday's close. With today's rally after Friday's bounce, that does get our short-term market trend model really close to the zero line. So if we would see further uptrend, and close really anywhere near above today's close here going into Friday, that would be a short-term bull confirmation. And what that would suggest to me is a counter trend rally within a cyclical downtrend and still within a secular bull market. And if you're not confused by that, that is where it's at. And we'll dig into this further as things go on. So the secular trend, the long-term trend's still fine. The medium-term and short-term trends to me still feel more negative until proven otherwise. The short-term model turning bullish would tell me to start focusing on potential rotation to the upside if we do get that upside follow through. In terms of stocks above their moving averages, I mentioned that the S&P did close above its 200-day moving average today. Totally true. Still slightly less than 50% of the S&P 500 members above their own 200-day. It's literally almost exactly at 50%. So you have half of the S&P above, half below. So that's way better than 35-ish%, which is where we were a couple weeks ago. So we're back to 50-50, but that's still a coin flip, right? So I would say the bull case from here means you have additional buyers coming in, pushing some of those key names above that key moving average. That is a long-term measure of breadth, and getting back above the 50% line would be a really bullish outcome of this week if that's how it would play out. Most stocks still below their 50-day moving average. So you're seeing an additional, sort of an initial bounce higher. Again, I'm still labeling this a counter trend rally until there's enough follow through for me to say, yep, this is now a new bullish phase. Not there yet for me. One breadth indicator where you have seen a pretty significant rally. It's actually pretty impressive how quickly it's moved. From about a week and a half ago, the bullish percent index on the NASDAQ 100 was down just slightly below 30%, which is, we have often treated that as a pretty compelling buy signal because that's when, the NASDAQ 100 has often bottomed out. Sure enough, kind of worked pretty well here because that was about a week and a half ago, and now we're getting this bounce into today's gap higher on the NASDAQ composite. What's interesting is if this continues to rally, we're not far from the 70% level, which would be one of the places where I start to look for a sell signal, start to look for the market being too bullish in terms of breadth conditions, and you probably get a counter trend reversal lower. So how did this happen so quickly, where we went from 30% to over 60% in about a week and a half? So it's all about how point and figure charts are calculated. Just look at the chart of the NASDAQ composite. We're in a downtrend, right? And so on the point and figure chart, this is probably just looking like a column of O's because we keep going lower, keep going lower. Eventually we stabilize. And then when you start having a column of X's higher than the previous columns, which means we need to move at least 3 boxes in the upper direction, you get a buy signal. And that's what's happened. So I would say the NASDAQ composites point and figure chart probably generating a double top buy signal today because of the breakout to a new column. And a lot of individual stocks over the last week are showing a very similar kind of rotation. So the point and figure methodology is all about breakouts and breakdowns. And the way that this played out with a downtrend, a bit of a consolidation, and now a bounce higher is exactly what point and figure charts do when they generate a buy signal off of the lows. So we're definitely seeing that here, at least in the short term. So the bullish percent index on the S&P, not this severe of a rally. It's the growth stocks in particular that got beaten down so much that are starting to rally higher. I mentioned my interview with Jay Soloff. I'd encourage you again to listen to that one for all things volatility. It was a really, really good conversation. I was really happy to share that with you guys. The VIX, for the record, over the last 2 weeks has come down aggressively, right? We got up to almost 30 at the end of the first week in March. We're now currently down around 1750 at today's close. We're below 20, which is sort of, for me, the back of the envelope level that separates a high volatility, high uncertainty, kind of environment versus a low volatility, low uncertainty, things are okay kind of environment. As of last Friday and now into today, I would say you're into a low volatility, things are okay kind of environment. It's worth noting when you go back here, if we would see the VIX continue to go lower and we would continue to see a counter trend rally, that's where we start to look for a very low VIX. A VIX in the low teens would be okay, maybe that is way too low of a volatility reading given the uncertainty we're actually experiencing and perceiving as investors. Maybe that's where you would find a short-term sell opportunity. For now, the VIX continuing to trend lower, telling you worries are easing in risk assets. Let's talk briefly about Bitcoin. I've shared the chart of Bitcoin a number of times here, so I don't want to belabor it too much, but I just want to point out that just like stocks like Meta are trying to hold their 200-day, the GBTC, which is a grayscale Bitcoin trust ETF. Of course, this was one of the first vehicles people could use that was not, just buying Bitcoin in a digital wallet. This was a trust structure. Now it's evolved into an ETF structure, and certainly still one of the largest. You can see it's bounced up to around 70 after bouncing off the 200-day moving average a couple weeks ago. Again, is this a super bullish chart? I would say not yet. What would make this a bullish chart? Holding the 200-day is a decent start. Getting back above the 50-day, RSI pushing higher, those sort of improving trend and momentum characteristics would help validate that this is a new uptrend. But today's bounce really may be starting to show follow through off of that bounce off of the 200-day moving average. So similar to stocks, I think you're seeing a very similar pattern in some of the cryptos. This is GBTC we're showing. And full disclosure, I do own GBTC in my accounts. All right, looking at offense over defense, just want to show you it's been favoring defense over offense pretty consistently. The cap-weighted version of this ratio from mid-January to early March, very much favoring consumer staples. The defensive side of the ledger over the last couple of weeks, we've seen a stabilization and now a bounce higher. The equal-weighted version actually topped out in early February, bottomed out now second week in March, now rotating higher. So we're certainly getting a nice bounce on these offense to defense ratios, really acknowledging that rotation higher in the XLY. And again, today was a pretty decent update with the XLY far outpacing the rest of the market on a cap weighted basis, which is Amazon, Tesla, those kind of names, but also on an equal weighted basis. Because it's not just the big names. The average stock in consumer discretionary is starting to outperform kind of the average stock in consumer staples. So this is another one to watch, I would say, along with like defensive sectors and how they're performing on a relative basis. These are great charts to watch to see if the recovery is enough to really start to buy into. All right, looking at some individual names here. We'll start with just one more macro kind of thing. I just want to show this alligator jaw super wide with a Magnificent 7 ETF down at 10% year to date. Gold up almost 15% year to date. It was a little more about a week ago, but now you're starting to see this rotation down where gold and bonds rotating down a bit. Magnificent Seven, QQQ, equal weighted S&P, all rotating higher. We're seeing again at least a short-term reversal of upswings in those risk assets and downswings in hard assets and bonds. But let's look at some of the individual stocks that are part of that Magnificent Seven bucket that have been underperforming and underwhelming, but now starting to bounce. One of the things we've talked about in terms of validating whether we get another big leg down, I would say the chart of Meta may be the most important one to watch. Something like Meta holds its 200-day moving average. I'm just not sure how bad things would get. But if Meta would fail to hold its 200-day, I can imagine some pretty bad scenarios that could play out, but only after that would happen, right? Because what's happening so far is you're seeing investors buying in on short-term weakness. I've seen plenty of buzz about buying the dips, and we're down 10% on the S&P, and that's a time to layer in. I get all of that argument. The problem is you often have a nice, beautiful, big bounce higher after the first leg down, and then you have that big wave 3 decline, which really starts to undercut things. The way I would validate kind of a wave 3 big decline in the markets would be Meta breaking its 200-day. That's where I have an alert set. I would encourage you to do the same. Keep an eye on charts like this, like Broadcom and others. There are a lot of them kind of holding the 200-day, and as long as those hold, things probably aren't going to get that bad. But if they fail to hold, that's a problem. Now, one of the most encouraging things I could tell you about today, when I think about evidence that I'm observing, what it incrementally adds to the picture, Amazon getting back above its 200-day moving average is a not insignificant thing for me. I think that's a pretty big deal because these Magnificent Seven names holding their 200-day is pretty crucial. If they break them like Amazon did, what you're looking for is a bullish momentum divergence with the price going lower on higher momentum. We kind of almost got that here over the last couple of weeks. And then these stocks regained their 200-day. The S&P regained its own 200-day moving average today. Amazon regained its own as well. So I would be looking for more Amazon kind of moves. Now, the question for Amazon, which can only be answered tomorrow and the rest of this week, do we hold that, right? We've now gapped above 200. We've now cleared the price range over the last couple of weeks. Was that the beginning of something, which means additional buyers have to come in tomorrow and Wednesday and through the course of this week, showing additional demand and pushing prices to the upside? If not, that's where this fizzles out very, very quickly. So I think Amazon, another one where the 200-day moving average is very much in play. I'll take a brief moment to talk about NVIDIA. This actually came from a question on the show, I think on Thursday. I didn't have a chance to include it in the mailbag episode on Friday. And if you missed that, it was a really good one. I think hopefully, and again, I say it's a good one because of your questions, which were thoughtful and gave me some great content to talk through. And I can't thank you guys enough for giving me some really good stuff to address on the show. But one question we didn't get to that I just wanted to share with you was the death cross on NVIDIA. So a death cross is where the 50-day moving average in blue crosses down through the 200-day moving average in red. A golden cross would be the opposite, where the 50-day crosses up through the 200-day. So what does that mean for the chart of NVIDIA? Let me jump over here. So what does that mean? So I would say, to be honest with you, it doesn't mean a lot, is my short answer, and I'll tell you why. The 50-day and 200-day, if you look at a really long period of time, so if we look at like 20 years on NVIDIA, and I've not done this to really think about 20 years is probably a little crazy. It's just too much data. Let's look at 10 years, right? And if you simply look at when the 50-day and 200-day cross up and down through each other, the reason why people like this is because it allows you to participate in the bulk of the moves, right? So for example, buy or bullish signal here, third quarter of 2019, before this nice uptrend phase, never crossed down until finally there, second quarter of 2022. And then that's the death cross where it crosses down through the 200-day. Here's a golden cross where it crosses up in early 2023 before this big uptrend. And we're maybe getting to another sell signal. Where actually we have gotten a sell signal here at the end of last week with the 50-day crossing down through the 200-day. Here's the problem I have. If you look at this death cross, it happened here. Now it looks like it's like almost perfect at calling the top, but if you look at where it actually hits, it's such a lagging indicator. So it actually didn't really occur until you have this gap down or right around that gap, which means it actually gave you the sell signal almost at the lows, right? I mean, it was kind of here in November of 2018. We did go a little bit lower, but I mean, that's really where you probably wanted to start accumulating because the trend ended up being higher. On the other side, you kind of get a buy signal here. Not bad, right? I mean, it's sort of like early days, really before it broke out. Here we have a sell signal, and it's way after the top in November of 2021. It took all the way till there until you really get a valid breakdown at death cross. We did go down a lot further in 2022. We finally got a buy signal way after. So in long-term trending markets like NVIDIA has had, the signals come way after the actual peaks and valleys, which is okay, but it only works if we continue to be in a trending environment. The problem comes, and I'm trying to think of a name that might be a good illustration of this. The problem comes when you have like a really choppy, noisy name, like trying to look, here we go. EA. I'm just trying like what's an annoyingly choppy sideways chart for a long time. This is why this approach generally cannot work, and it's when a stock gets in a really choppy, sideways, volatile time. Look at the number of times that the 50 and 200-day moving averages crossed above and below each other during this period, including a bunch of really painful signals. We almost wanted to do the opposite through the course of 2021 through 2025, and most recently, it gave you a big death cross here at 130 after the low at 115 and before it's continued to rally higher. So that particular system using the 50 and 200-day moving averages works as long as you have these big long-term trends to play with. The problem is it's really hard to anticipate that that's going to happen tomorrow. It's very easy to look back and see, wow, NVIDIA, that would have been a great way to do it. But it's hard to tell right now whether NVIDIA is going to look like this or whether it's going to look more like this going forward. And if you bet the house on the crossover of the 50 and 200-day, it could end up being like this. So I've found that there are other ways to measure trend in a way that I've found much more successful and much more effective than that particular thing. However, everything I've said, all the data that backs that up is widely available. And it will never stop people from asking about a death cross because it's something that is easy to see and it can work. So does this mean NVIDIA is giving you a 2022 kind of signal? It is. Is that any guarantee that the next 6 months are going to keep going down? It is not. And that's why I hesitate to make a ton of noise about the death cross. I hope that was a 5 to 7 minute treatise on the death cross. Noteworthy. I'm telling you, it's there. Is it the best trading system I've ever come up with? It isn't. It works sometimes very, very well. And on long-term charts of things like the S&P and NVIDIA, obviously, and other names, you'll find generally being on the right side of that is not going to be bad. The problem is in really choppy markets, it'll get you a bunch of little whipsaw signals that end up making you want to pull your hair out. And so that's why I don't use it as much. All right. Elsewhere in the technology space, AMD breaking above its 50-day moving average for the first time since October. So this is a stock that gapped below its 50-day back here after a stalled breakout above the 200-day. And by the way, this is why when I see the like Amazon breaking above its 200-day, this is what's in the back of my mind. I've seen enough AMDs that do that, and then immediately it's repelled, and the next day is just the initiation of this big downtrend. So that's why I'm not a big like, it closed above the 200-day, that's it. I think you need follow through. You need that confirmation. We didn't get it here, and it trended lower and remained below two downward sloping moving averages through Friday. Today, we're back above the 50-day, which is good. The RSI is pushing above 60, which is encouraging. This could be the beginning of a decent recovery for AMD. So I'll take that. Palantir is another one, and again, I get the temptation on charts like Palantir. Palantir, to be honest with you, looks like a lot like the chart in Netflix. There's Palantir. Whoops, I just looked at too complete. Right, here's Palantir and there's Netflix. I mean, they're almost the same chart right now with the highs in February. And I'm sorry if I'm making you dizzy going back and forth, but you can see how similar those two are. Very, very similar in terms of a primary uptrend. I would say out of all the charts I'm going to show you, Palantir probably looks the least concerning because we're still making higher highs and higher lows. And I think that's what differentiates charts like Palantir and Netflix from others, is because they're in their uptrends. Most recently, Palantir pulled back and the RSI stalled out at 40, which is actually still very much in a bullish range. The problem is that move is like 125 down to 75. That is a huge haircut within about a 1 month period. So the volatility is real, but if you can stomach the volatility, the trend overall is strong. And I would say it's still very much in a primary uptrend in a way that, I mean, there are very few stocks that are still above two upward sloping moving averages. And I think that's what's important to celebrate on the chart of PLTR. All right. I saw some really good questions coming in. Let me see how many I can get to. And those I do not get to, I will put in the mailbag and hopefully get to them at the end of this week. Todd, thanks for watching on X. You asked would be great to take a look at IWM. I've talked about the chart of IWM like 3 different times, and I've not actually shown it. Shame on me. All right, let's go back to this one, and I'm just going to show the chart of NVIDIA with its death cross. Keep that in the back of your mind. Here's the chart of IWM. So the death cross is similar, right? We can see that here with IWM. It's kind of almost, not quite there. I mean, it's right there. But again, the problem I have with, just look on this 2-year chart of the IWM and the same 50 to 200 day golden cross and death cross. Just think about what the chart would have told you to do if you followed that as a trading system. There's your sell signal, where it's a death cross. There's your buy signal, which is a golden cross. There's your sell signal, which is a death cross. There's your buy signal. Horrible signals all through this period. Great here when you're riding the uptrend higher. So it's like, as long as the market trends, it's fantastic. But the moment we're in more of a range-bound environment and it's more about mean reversion and less about trend, that system absolutely kills you. And unfortunately, it's really hard to predict the future and know whether something's going to be in a trending phase or a non-trending phase. And so again, I found other indicators like RSI and others just better at helping me identify those trend reversals better than a crossover technique like this. If I was going to use a moving average crossover technique, as you may know from my market trend model, I would use exponential averages. They're just better at detecting changes in trend. So that's what I would think about. So what is the chart of IWM telling you? So it's a death cross again, as you probably picked up on. That is not a huge news for me. What is news for me is we're way below the 200-day moving average. We're bouncing kind of off of these lows from June and August, kind of last summer, and we're rotating higher. Again, the 200-day moving average is looming very large for me around 217. The RSI most recently, we rallied up to the 50-day and the RSI stalled out at 60. So I would want to see that change. I want to see a push above the 200-day on stronger momentum. And until then, this certainly looks like a counter trend rally within a downtrend. The other thing you can do with a chart like this, you could probably almost just see it. It almost jumps off the page. You can use a trend line off of these major highs, right? So that's kind of the upside within a trend channel. And you can even, that was horrible. You can even draw a parallel line. And boy, it's not perfect, but you get the general idea here. We're kind of in this, lower highs, lower lows thing, which means we can get up to kind of 215, 217 and still be within a larger downtrend. And so that's where timeframes really matter, right? Thinking about, what a nice rally, a nice bullish signal on the tactical time frame could still be a bearish trend on the cyclical or the medium-term time frame. That's something I'm observing with something like with IWM. 3P Investor, thanks as always for watching. Boeing. Atypical inverse head and shoulders pattern, breaking through the neckline, a bit skewed head. Okay, I'll bite. I'll take a look. And actually, friend of market misbehavior, Ari Wald, technical analyst at Oppenheimer. I've had him on my podcast and interviewed him many times. Just a really, he is a great success story, I would argue, of a technical analyst at a big firm, representing the discipline well, doing well with media. He's awesome, and I'm very happy to be able to chat with him whenever I can. He talked to me. He was on CNBC earlier today or yesterday talking about Boeing as a bearish chart, basically because we were rallying up to that resistance level, which I would agree. And the long-term chart is just still so ugly, even though we've had this nice short-term rally. Your question, though, 3P Investor, atypical inverse head and shoulders pattern breaking through the neckline. Ooh, I don't know if I'm going to I don't know if I'm going to agree with you, but let's take a look here. It depends on your time frame. So it depends on what you mean here, right? So there are actually a couple different things to think about. I don't know if you're thinking about like this, and you're thinking of like a shoulder, head, and shoulder, in which case that's not a great, that's a really kind of a weird, that is a very unorthodox one. Or you could be talking more about like this. I'm not sure. This chart does not scream inverse head and shoulders bottom to me. And I guess this is just a weird misshapen kind of pattern that doesn't look like it anymore. This really is on the very short, maybe like on the hourly chart, could look like an inverse head and shoulders bottom with a break above there, but I don't know. You could be talking about like this. Is this a left shoulder and a head, and then maybe a right shoulder, and maybe, but I think we would still have to wait to see that sort of neckline form. So for me, inverse head and shoulder does not jump off the page at me. For me, it's more about support. Now, did Boeing find support before it got to the November lows? It did, in 145, and it bounced higher. Does it need to get above this resistance before it's anything but a pretty ugly chart? I would say it does. It's above the 200-day moving average. That's encouraging. Gap lower, gap higher. That's good. Lows, and we've rotated higher. The momentum is improving. All of that's good, but you really need to get above this resistance and to sustain any sort of upside there. So unfortunately for me, I think Boeing is rallying up to a bunch of overhead resistance. That's how we would describe it. For me, it's still wait and see mode. This is more something I'd probably be playing on the downside until proven others. This is one of those like short with a stop around 187, right? So you're playing downside, but you close it if we get above the February resistance. That's more from a technical perspective what that chart is telling me. But I'd be curious if you guys think differently. That'll do it for today, folks. Thank you guys so much. As always, awesome questions, fun charts, and I can't tell you how much I enjoy doing the show and sharing some charts and perspective with you. Thanks for watching me. Thanks for supporting Market Misbehavior and following my content on the channel. As a reminder, we have a webcast coming up this Wednesday at 1 p.m. Eastern, 10 a.m. Pacific, called Relative Strength Top. I can't even remember the name. It's about relative strength, and it's going to be awesome. So go to marketmisbehavior.com/relative to sign up. But for now, have a great night. And remember, it's always a good time to own good charts. Take care, folks.